Hello and welcome to Econoday Unplugged. It's Tuesday, 8th of October 2019. So just 5 days away from a highly anticipated 53rd World Conquer Championships being held in the UK this weekend. Mark Pender is on the US East Coast, Brian Jackson joins us from Sydney, and I'm Jeremy Hawkins here in London. Brian, I don't know if Conquers are a big part of Aussie sporting heritage, but either way, let's kick off with your side of the world. Since you last joined us, we've had fresh cuts in benchmark interest rates in Australia and India, another reduction in bank reserve ratios in China, and comments from a number of regional central banks to the effect that there may be more easing to come. We've also had an escalation in a political crisis in Hong Kong and less than smooth progress in the US-China trade talks. So there's been plenty of news, but would it be fair to say not much of it good?
I think that's reasonable. Yeah, it's definitely if you look at the data that's coming in over the last few weeks, it's generally been on the subdued side. Central banks are looking at inflation as well, and generally seeing it below where they would like it to be. And so the bias right across the region is still towards more rate reductions. You've had, as you said, the RBA, the Reserve Bank of India. The Chinese also cut their new benchmark lending rate a little a few weeks ago. Right across the region, it's quite subdued.
So why have Japan just hiked their consumption tax?
Well, that's been in the pipeline for quite some time. So I think the government there feels like they are committed to going ahead with it. They've adjusted that in the past as well, and they've generally sort of been able to respond to that with other measures. And obviously the Bank of Japan just keeps policy very, very loose as well. So I don't think they've really been doing that as part of a macroeconomic policy tool, but rather to improve their revenue base and to improve the fiscal position. What we are seeing, though, in Japan is again, that this bias towards doing more on the monetary policy front is in place. They haven't acted, obviously. They've been very stable for several years now, but we are seeing a bit of a change in the rhetoric coming out of Japan. As we know, inflation has been very slow to come up to where the Bank of Japan's target is. And what they've been saying, though, all along is that the momentum is still there. That has changed a little bit in the last couple of months. Now the BOJ is saying, well, perhaps the momentum is starting to come off a little bit. And what Governor Kuroda has said is that if that momentum is lost, they will act, in his words, without hesitation to ease policy further.
What do you think they'll do? Are we talking more QE type stuff or another cut in rates, or where do they go?
It'll be some sort of balance. It's really hard to predict exactly what it'll be. They've got probably 3 or 4 sort of levers that they can pull. But the key point is that they do believe that, they have a room still to ease policy further if they need to.
Brian, this is Mark. Do they think that the yen is too strong?
Yes. They would always like to see that come off a little bit and help them out. So that's another factor that's weighing on the policy front.
What about China? Most of the numbers out of there, I suppose they've been a little bit mixed, have they, of late? But, there are still concerns about which way China's heading at the moment.
Yeah, it's probably best just to look at the most up-to-date numbers, which are the PMI numbers that we've had out over the last week or so. Obviously, we've had China out on holiday for the last week, so we haven't seen any of the official numbers come out. They'll come out shortly for September. But if you have a look at the PMI surveys that have come out, you'll see that last month there was a bit of a pickup in manufacturing, then it dropped off this month. But the opposite for services. It dropped a little bit last month, then picked up a bit this month. So we have seen, if you sort of combine those two together, the composite measures for the PMI survey have inched higher over the last couple of months, but still sort of at showing quite subdued levels. Perhaps that does suggest that some of the moves officials have taken in the last few months to respond to the weaker trade situation has helped to stabilise domestic activity, but it's by no means reignited very strong growth in China.
Do you think forecasters are going to start inching up expectations for their industrial production retail sales reports?
If you look at the PMI numbers, and as I said, they've picked up a little bit over the last couple of months, that does suggest perhaps we'll see some improvement, but I wouldn't think that it's going to, really get that much stronger. But hopefully it's at least trending in the right way. The other thing to note, obviously, of course, is just this: the whole Hong Kong situation is flowing through to other issues as well. What has been quite striking in the last couple of weeks is just the impact it's starting to have on broader US-China relations. Obviously, we've seen US politicians coming out expressing concerns about what's happening in Hong Kong, and it's also starting to impact some of the commercial relations. You may have seen the situation that's going on with the National Basketball Association in the US. We had a manager of the Houston Rockets expressing support for the Hong Kong protests, and the reaction from Chinese companies has been quite severe in sort of damaging that relationship that the NBA basketball has had in China. You've had the state broadcaster suspending broadcasts of basketball games. So again, just highlights the sensitivity of much of the US-China relationship at the moment.
How has Australia dealt with this and their politics versus and exports versus China?
Very nervously. Obviously China is our most important trading partner, but the US is our most important security partner. Our longest standing and our most important ally. And so I think that the Australian government is keen to try and get this resolved as quickly as possible, and in the meantime, say as little as it has to, when anything controversial comes up, because obviously doesn't want to upset the apple cart in either direction. So it's a very delicate situation for the Australian government, no doubt.
So I was wondering, does this typically, I suppose, for your sort of part of the world, and it's the yen, which is normally regarded as being a sort of a safe haven currency. But I was wondering, has developments in Hong Kong been for the benefit of places like Singapore?
In terms of
capital flight going into us?
I think that's definitely that would be a longer term trend. I think you're probably not going to see companies pull up and move just right now. It's only been a few months, but if this does continue and if things escalate, then you would definitely expect to see some relocation and some capital flow elsewhere. And so I think the Hong Kong authorities are obviously very concerned about that. And if you just look at the PMI data for Hong Kong over the last 3 months, it's been terrible. It's just completely collapsed, and all sorts of weakness in terms of exports and employment going on there. Again, what we're seeing is also concerns about where does Hong Kong business stand in relation to this issue? Are they on the side of the government or are they on the side of the protests? And depending on what choice individual businesses make, they're going to come under pressure from some quarters as well.
Okay, interesting stuff. Thanks for that, Brian. Okay, to Mr. Pender. Mark, before we get started on the economic data, and I thought I saw something just now, but the Fed's about to announce it's going to resume buying T-bills for reserve management purposes. First question then, does this have any implications for policy?
Well, no. That, and Jerome Powell's very careful to state that this is the temporary purchasing of short-term securities to add liquidity into the money market. Quantitative easing is the long-term purchases of long-term securities. So he's put a Chinese wall between that, but he's moved up the schedule. Last month's FOMC conference, he was talking about the end of October, the Fed addressing this. So they've gone right in to do it. And it's because of the jitters. It fairly or not, it raises questions of counterparty risk and those kinds of things. And so they want to put a cap on as soon as they can.
Fair enough. Okay, let's get down to the numbers. So last Friday, US jobless rate hit something like a 50-year low, but you also saw
3.5%, yeah.
Right, and you also had a fall in wage growth, though, slowest pace in more than a year. So, I mean, isn't this kind of sort of Goldilocks almost as far as the US is concerned? What's the Fed worried about?
Well, I guess it could be considered Goldilocks. The rate of payroll growth is moderate. That's pretty solid at 136,000. The lack of wage inflation really doesn't really play into their interest in trying to raise inflation right now. It was a surprise. Average hourly earnings had been on a 4-month, significant 4-month rise, but they came in unchanged monthly in September for a 2.9% year-on-year rate. All of a sudden, that rate has gone down about a half percentage point over the last since earlier in the year. And they want to, I think, to have a basic inflationary upward movement to it. And also, they talk about the importance of wage gains for the standard of living issues. That's always kind of part, business writing kind of excludes that, but that's always really at the top or at how they address the public. So I think that they would, it's not really good press for them to have a weak wage growth. We also have producer prices today, and they were soft too, kind of going in the wrong direction, roughly around the 2% annual rate, but it's moving, and it's coming back. Energy has a lot to do with this, but basic goods prices really aren't showing any traction. Finished goods prices aren't showing any traction. And tariff effects, where they are, they're hard to find. So it's not really creating any issues for the consumer, at least yet. We have consumer prices on Thursday, but there again, forecasters are expecting to see moderation. So, and Powell is out today speaking, and he sounds a little bit hawkish. The Fed's strategy seems to be the last meeting too, to cut rates and talk hawkish. And I think that's what they're doing now. And I think part of the subtext is, defending their independence from President Trump. So I think this is kind of what their strategy is. Markets are certainly expecting a cut, and it would be it would be a big move if the Fed didn't meet market expectations, but they're going to probably meet them in this, slow kind of, slow way.
Okay, quick one round off from your side, just the politics. I don't normally talk about US politics, but all this, impeachment rumors and talk and so on, is that having any kind of unnerving effect on US markets, financial markets, or are they kind of just ignoring it?
I think there was a burst into the bond market when it first kind of came out. So that would be demand for safety. And there was already building up demand for safety, including among small investors. And that probably reflected that, of course. But since then, there has been, I think, definitely flattening, tailing off of seeing, what is going to unfold exactly. And certainly, this is just another element of polarization in the American public. Whether that's good for the markets, I don't know. But the battle lines are more and more drawn than ever, and so we'll see how it plays out. However it is, it's going to be loud and probably very nasty. But whether or not that actually affects, fundamentally affects investors' viewpoint of the market, it could from day to day, given, super strident headlines. But generally, I don't think it's changed the picture, certainly the monetary policy picture at all.
Okay, fair enough. Thanks for that. Okay, quick look at my side then. Well, from the Eurozone, there's not a great deal to add from what we said last week. On the economic side, I guess most of the talk over here continues to be dominated by Germany, where there seems to be growing speculation about a possible recession. We had some manufacturing numbers out this week, which I guess weren't quite as bad as they might have been. But in a nutshell, as far as things stand currently, in September, we need to see monthly growth of industrial production of getting on for 3%, just just to prevent the third quarter from producing another contraction, which would put manufacturing into technical recession. Business surveys and orders continue to be very soft, pointing to a disappointing fourth quarter as well. And I guess the most worrying aspect and the key thing to keep an eye on here are German services, which according to the recent PMI surveys have also started to show signs of deceleration, and obviously it's been that part of the economy which has really been keeping German GDP head above water in recent quarters. The rest of the Eurozone,
I'm sorry to interrupt, but the spin on the German industrial production seems to be it was a better report than it wasn't as bad as it looked report. Did you see that?
Yeah, that's a fair point. I mean, market expectation, we're talking here about the August data. The expectations was for a decline of 0.1% on the month. We actually had a 0.3% monthly increase, which in itself is a bit stronger than expected. And indeed, if we stripped out fairly large declines coming through in the volatile subsectors, energy and construction, we're talking about an increase up around 0.7, 0.8%. So in actual fact, by German standards of late, it was a pretty decent number. But that figure needs to be seen in the context as what's been a raft of really pretty terrible numbers over previous over previous months. And I think with the September PMI, I think we talked about that last week, really looking terrible for German manufacturing. The chances are that this is just going to be a temporary blip, and we'll probably see it unwound when we get the October numbers coming out. So by and large, putting a straight line through the German figures for manufacturing, at least they still look pretty awful. Regards the rest of the Eurozone, it's doing better than Germany, which is the good news for the Eurozone total at the moment. And so I think, talk about recession, the Eurozone is really getting a little bit ahead of itself, at least at this stage. But it's got to be said, if we just go back to these PMIs again, in terms of manufacturing, as of the September figures, only Greece, Netherlands and France were on the right side of 50. All the others, so that includes the likes, obviously Germany, but Italy, Spain as well, they're always sub 50, and so in negative growth territory. So although Germany by all means is the worst performer at the moment, there's some genuine concerns about the broad-based deceleration we're seeing in the Eurozone currently. What does it mean for Christine Lagarde? Well, one of the problems, I think, clearly we've just seen the ECB easing policy just a few weeks ago now, but from some of the comments coming out from Executive Council, there's clearly disagreements about, should they have cut interest rates in these policy last time, let alone what they might do in the future. So when Christine Lagarde does take over from Mario Draghi at the beginning of, November, she's going to have her work cut out if she wants to see any additional easing. So there could well be some fireworks on the ECB to look forward to. But I'm round off my bit with the UK, and inevitably it's got to be Brexit. From the volatility people might have seen in the pound today, you can tell that there's been quite a lot going on there. In summary, what's happened, there's been some reports coming out from Germany, which it has to be said the German government have not corroborated, that Angela Merkel has effectively said that Boris Johnson's latest proposals to secure some kind of a trade deal before the Brexit date on October the 31st, that effectively they're unworkable and they're not going to be acceptable to the EU Commission. There's been a lot of rhetoric since then flying between the UK government and the EU Council, and markets have suddenly now taken a view that there is that much more of a chance of the risk of a no-deal Brexit. Now, of course, I'm sure people will remember, as we keep talking about, that strictly speaking, as a result of a new so-called Benn Act, the Prime Minister is obliged to request an extension of Article 50, which would delay Brexit if he can't get a trade deal agreed by the 16th of October. But what worries the markets is that the Prime Minister over here is still maintaining that come hell or high water, the UK will be leaving the EU with or without a deal once we get to October the 31st. So now the fact that he's still saying this, and we've had this, what appears to be a big blow to the trade negotiations, financial markets getting significantly spooked, and we've seen the pound come under quite a lot of pressure pressure during the course of trading out of London today. I think markets can be very nervous over the next few days. There's been talk that Johnson may not be attending next week's EU leaders meeting, the leaders meeting, which will be the last one before Brexit. And that's also been seen as perhaps, well, further indication that perhaps we are going to leave without a deal. But wherever it pans out, markets going to be extremely nervous, I suspect, over the course of the next few days. So it's going to be very much something to keep an eye on.
Now,
In terms of numbers, yeah.
Oh, I'm sorry. I have a couple.
No, I was going to say in terms of numbers.
Urgent. I have a couple of urgent
Yeah,
Brexit questions. So when October 19th it comes around, and if nothing has happened, will it just go to Parliament then, and they will try to force an extension?
Well, yeah.
Is that?
In theory, I don't have to, because under the law, which was passed a couple of weeks ago now, if there is no deal agreed effectively by the time the EU leaders meeting, then the Prime Minister under law is obliged to write this letter and officially request an extension from the other EU members.
So this letter is already typed up somewhere?
It may well be. I mean, the Prime Minister, which makes it even more confusing, has already said he will not be breaking the law if he has to write the letter, and he will do precisely that. But the next sentence he will say, but by the way, we are still leaving the EU with or without a deal on Brexit Day. So, I mean, clearly, it simply doesn't square. Markets have got no idea whether he's got some cunning plan or some loophole he's found in this new act, which allows him to drive through it and take the UK out of the EU without a deal, or whether he's just bluffing or what. At this stage, we really don't know.
And so then the courts would be pushed into some kind of emergency hearings?
Yes, there has been talk that he could be wheeled before the Supreme Court and possibly even locked up in prison should he refuse to do what he's supposed to do. So, I mean, it really is. It's a political comedy if it wasn't so sad over here at the moment.
Well, one last question, and this is a befuddler for me, is the border, the customs border on Northern Ireland. What is it that the EU doesn't like about Boris Johnson's proposal?
Well, in a nutshell, Boris Johnson's proposal would mean that Southern Ireland would be taken outside of the customs union. And that is something they're not prepared to have. Effectively, Johnson is proposing that there would be a kind of a border, a very loose border between Northern Ireland and Southern Ireland, which at the end of the day, the rest of the EU simply aren't prepared to accept. So they simply want, completely free trade between all the EU members, which will include Southern Ireland. But Southern Ireland has some kind of, maintains a free movement of goods and stuff with Northern Ireland, but there are also some blockages to other things, then they're not going to stand for it. So it's basically just comes back to this backstop, which the issue of this has never been solved. It's just the perfect storm of having, when everyone's in the EU, the free movement of capital, goods, people is not an issue. But when one country leaves the European Union and still wants to maintain all that free movement, it simply doesn't work anymore. And it's trying to work your way around this, which has caused all the headaches, and it still hasn't been resolved. And lastly, I suppose I should just quickly mention on this subject, it is still the case that even if Mr. Johnson does write the letter to the EU, it's down to the other EU members to agree to it. And all the other EU countries, all 27 of them, have to say, yes, it's fine for the UK to have an extension. I think at the end of the day, because the EU really, really, really does not want the UK to leave without a trade deal, they will give the nod. But there's been a lot of noises coming out of some member countries, basically to the effect they're just getting fed up with the whole thing. So, on which happy note, I guess we should probably just about call it a day there then. On behalf of Brian, Mark and myself, thanks as always for listening. Do remember to keep up to date with all the key economic indicators and market events in Econoday's global economic calendar. And of course, don't forget to dig out your conkers in time for Sunday. Bye for now.